Welcome back to the Magic Market, where we break down the biggest topics in the financial world so you can make better investment decisions. Today, we're diving into whether Disney stock is a good investment in 2024. From its streaming wars to theme park revenue, and even its new CEO's vision for the future, we'll look at everything you need to know before making an investment decision. Let's jump in. Disney, ticker symbol DIS, was founded in 1923, and it's evolved into a global powerhouse in the entertainment industry, with diverse business segments that include media networks, theme parks, studio entertainment, consumer products, and direct-to-consumer streaming services like Disney+. But Disney's financial journey has been anything but smooth, with significant highs and lows that have shaped the company as we know it today. To understand Disney as an investment, it's important to know how each of these segments contributes to the company's revenue and profit. Disney has experienced multiple financial highs, often correlated with major strategic moves and acquisitions, such as when Disney acquired Pixar for $7.4 billion in 2006. For $4 billion, Disney bought Marvel, a decision that paid off tremendously. Disney purchased Lucasfilm, the studio behind Star Wars, for $4 billion in 2012, and finally, Disney's entry into the streaming market with Disney Plus marked another high point. Although these were high times for Disney and its investors, there were also tragic lows, such as when Disney was affected by the 2008 financial crisis, when Disney's media networks, including ESPN and ABC, have been challenged by the shift from cable to streaming, and hugely when the pandemic broke out. Disney was hit hard, as theme parks and resorts closed, cruises were halted, and movie theaters shut down, delaying major film releases. With that context, let's zoom in on Disney's current financial performance in 2024. Disney reported mixed results this year, with some areas showing growth while others face significant headwinds. Streaming, which was once seen as Disney's growth engine, has hit a few roadblocks. Disney Plus saw slower subscriber growth, partially due to price hikes and increased competition from Netflix, Amazon Prime, and Apple TV+. Content costs remain high, and the streaming division is still not profitable. This year, Disney is trying to shift its strategy toward profitability by exploring ad-supported tiers and a more selective approach to content production. On a brighter note, the Parks, Experiences and Products segment has been a star performer. With demand returning strongly post-pandemic, Disney has benefited from increased ticket prices, in-park spending, and new attractions that keep visitors coming back. Despite economic uncertainties, consumers have shown a willingness to spend on travel and experiences, and Disney's parks are prime beneficiaries of that trend. Now let's talk about media networks, which has been under substantial pressure in 2024. This segment includes ABC, ESPN, and Disney's various cable channels, which were once cornerstones of the company's revenue. However, the rise of streaming has led to a wave of cord cutting, as consumers move away from traditional cable subscriptions. This decline in cable subscriptions has had a direct impact on advertising revenue, with fewer viewers watching traditional broadcasts, particularly among younger demographics. Advertising budgets are also down as companies become cautious amid economic uncertainties, compounding the challenges for Disney's media networks. To offset these losses, Disney is attempting to integrate more of its media network content into streaming. ESPN, for example, has expanded its streaming presence with ESPN+, and there have been rumors that Disney might move ESPN entirely to a direct-to-consumer streaming model. This would be a major shift, allowing Disney to capture younger, digital-native audiences who might not engage with traditional cable packages. Disney has also hinted at the possibility of strategic partnerships or even divestitures to focus on core areas of growth. In fact, Disney has been exploring ways to streamline operations by considering a potential spin-off or sale of some media assets. CEO Bob Iger has publicly acknowledged that the company is open to partnerships that could make the media network division more profitable, or provide additional capital to fuel growth in parks and streaming. While this shift to a more focused and digital-first approach presents new opportunities, it also comes with risks. Moving ESPN fully to streaming, for instance, would require a significant restructuring of its business model, and the shift could alienate some of its existing viewership base. Furthermore, ad revenue on streaming is often lower than on traditional cable, so there's a delicate balance Disney must strike to maintain profitability. Lastly, Disney's financial performance in 2024 is also shaped by broader macroeconomic conditions. Inflation has raised operational costs across the board, from employee wages at theme parks to production costs in streaming. Rising interest rates also increase the cost of debt, which impacts Disney's ability to fund new projects or expand without taking on higher expenses. Additionally, with fears of a potential recession, consumer spending could weaken. While theme parks have been resilient, there's a possibility that discretionary spending on travel and entertainment might slow if economic conditions worsen, affecting revenue from ticket sales, in-park purchases, and vacation packages. To navigate these challenges, Disney is focusing on balancing long-term growth with immediate cost-saving measures. In addition to restructuring its streaming and media network segments, Disney is also scrutinizing operational efficiency across all areas, aiming to improve its profitability and cash flow. While Disney's fundamentals remain strong with a highly valuable brand, iconic franchises, and a global reach, the company is in a transitional phase, managing the shift from legacy media to digital and adapting to new consumer behaviors. In 2024, Bob Iger returned as Disney's CEO, a decision that has significantly influenced Disney's strategic direction. Iger, known for his visionary approach, previously transformed Disney into a powerhouse by acquiring key assets like Pixar, Marvel, and Lucasfilm. This legacy has earned him considerable trust among shareholders, who are hopeful he can steer the company through its current challenges and set it up for sustainable growth. One of Iger's primary focuses since returning has been to double down on Disney's core intellectual property. He understands that Disney's iconic brands, Marvel, Star Wars, Pixar, and Disney itself, are among the company's greatest assets, consistently attracting fans across generations and driving revenues in multiple segments. Iger is committed to leveraging these assets more strategically, ensuring they are central to the company's streaming, merchandise, and theme park experiences. For shareholders, this focus on high-value IP is a reassuring signal, as these brands tend to generate consistent demand and loyalty. By emphasizing these franchises, Iger aims to boost profitability and capitalize on established fan bases, potentially creating more predictable and stable revenue streams in an uncertain market. To improve Disney's profit margins, Iger has introduced a series of cost-cutting measures and is exploring the possibility of divesting underperforming assets. For example, Iger has been considering the sale of certain media networks and entertainment assets that no longer align with Disney's long-term vision. This includes the potential spin-off or sale of ABC, a legacy asset that has been losing relevance as consumers shift away from traditional TV to streaming. By selling or restructuring these lower-growth segments, Disney can focus more of its resources on high-potential areas, which could lead to better returns for shareholders. The decision to streamline operations also includes workforce reductions and efficiency improvements across various business segments, particularly in content production and media networks. For investors, these moves signal a commitment to improving Disney's bottom line, which is particularly important in an era of rising interest rates and inflation. By cutting costs and narrowing Disney's focus, Iger aims to position the company as a leaner, more agile entity that can better adapt to industry shifts. However, divesting assets and cutting costs isn't without risk. While Iger's cost-cutting approach could benefit profitability, it may also lead to a temporary slowdown in Disney's content output or a loss of experienced staff, which could impact the quality of Disney's offerings in the short term. For shareholders, this could mean some near-term volatility as the company balances immediate profitability with long-term growth. Iger is also placing renewed emphasis on Disney's streaming and direct-to-consumer strategy, which has been both a high-growth opportunity and a source of challenges for the company. Recognizing the competitive pressures in the streaming industry, Iger is focused on making Disney Plus profitable. This includes shifting from a rapid expansion model to a sustainable, profitability-focused approach. For investors, this shift could mean more stability in Disney's stock performance, as it shows the company's commitment to making its streaming segment financially viable. Disney has already introduced an ad-supported tier for Disney+, which has shown early promise in attracting cost-conscious customers and generating ad revenue. Iger's strategy to curb content spending and focus on quality over quantity is another sign of this new direction, as it seeks to improve margins and reduce streaming losses. One of Iger's ambitious goals is to explore partnerships in the gaming industry, recognizing the value of Disney's IPs in interactive and immersive experiences. This move could open new revenue streams, as gaming is a rapidly growing market, particularly among younger audiences who are highly engaged with digital content. Disney's extensive IP portfolio gives it a strong foundation for potential successes in this space, and partnerships could allow Disney to enter the market without incurring the high costs of developing its own gaming infrastructure. Bob Iger's return as CEO has brought optimism to Disney's stock, as he takes a decisive approach to reshape the company for a more competitive landscape. So after all this analysis, is Disney a good investment in 2024? For long-term investors, Disney could be a strong pick. With its valuable brand, global reach, and diverse revenue streams, the company has a solid foundation. Under Bob Iger's leadership, Disney is focused on its core strengths: high-demand IPs, a profitable parks segment, and streaming growth, which could lead to sustainable long-term returns. Iger's pivot towards streaming profitability and content cost control shows Disney is shifting from aggressive growth to a more balanced, profit-oriented strategy. For long-term investors, this focus on profitability may be reassuring, as it's aimed at turning Disney Plus and other streaming services into steady revenue contributors. However, short-term investors might find Disney's stock too risky right now due to economic uncertainties, high competition, and the company's transition phase, which could affect near-term stability. In summary, Disney is a potentially rewarding but high-risk investment in 2024. If you're a long-term holder who believes in Disney's brand power and adaptability, it may be worth the wait.